Hey, Dan Passarelli here. Well, I saw a little bit of chatter in our chat room on this, and I wanted to kind of maybe clear up some misconceptions and definitely share some of my philosophy on option premium and what affects it and whether it's time decay or Vega. And does the line sometimes blur a little bit? So this here is a picture of, a live screencast here of Royal Caribbean RCL. Now, at the time I'm shooting this after the close, Monday, February 4th, it has earnings coming out before the open tomorrow morning. So you look, and the 4-day options, the ones that expire first after earnings, you know, their premium's pretty jacked up. It's 85%. And then, you know, it goes down to 62.9 and 53.6, 52.01. You know, it's fairly typical term structure for an earnings play right before earnings. But, you know, if you were watching this over the past week or two leading up to earnings, you would have noticed a couple of things. So first of all, if you were paying attention to just the option premiums, you know, they might not have changed all that much. Now, of course, they would have changed with Delta, but they would have been sort of getting higher, all else held constant. Like if you hold constant only Delta, they would have been getting higher in terms of, well, in terms of what? Was it in terms of Vega? Was it the Vega was going higher? I mean, looking at this, I would say the answer is pretty clearly yes. But you could also have looked at it and thought, man, these options just aren't decaying in value. Was the Theta simply just not coming out and the market makers not moving their days ahead? Or were they moving their days ahead, taking out time premium, but then jacking up implied volatility? Again, really, a market maker tweaking his or her model could have achieved the same option premium, the same result, by doing either. But in fact, what's really more common is to move the day ahead and raise implied volatility. And look, if you look at the Theta versus the Vega, if Vega rose 10 points, like maybe it was 75 yesterday, if they simply left it at 75 but didn't take the day out, then that would have been, you know, 33 cents of Theta that didn't, or 33 cents of option premium that didn't come out of it. So when it comes to earnings trading, it's my opinion that Theta is not really all that relevant, you know, because what is the main thing where trading a time spread, which is a big factor on how the total earnings domination system works, buying, you know, one of the further back options and selling this option. Traditionally, we think of selling options as I'm trying to make money on Theta, but really in this case, it's the least of our focus. Our main focus is the Vega, and for the Vega to collapse, because if implied volatility falls from 85 down to 55, 30 points, that is a much huger impact than what the Theta impact could be. And I think that's fairly common for traders who use pricing models to think of it that way as well. I hope that helps. This is Dan Passarelli, Trade Smart.